want to leave my money alone.
A court can order that there be these payments, sort of like child support payments, that continue for a long period into the future.
What will the court consider in terms of criteria to determine if that guy is potentially liable for
It has a sort of extortion. In other words, what's really happening is the threat of ugly, embarrassing litigation, which takes place incidentally with average Joe.
It's really a frustrating position to be in.
Well, welcome to another episode of Cash Counsel. My name's Joe Cordell. We're going to focus tonight on issues that I think are probably pressing to all Americans today, and that's the issue of taxes. But we particularly want to think about how it might have application to those who are in the divorce process, though not exclusively those in the divorce process. Those of you who watch Cash Counsel, you know that kind of our concept here is to think about people who are about to get divorced, who are going through the process presently, or who've emerged from it. But at the same time, we want to give useful information that affects areas in addition to those specifically related to the divorce. So Cash Counsel has a little broader objective, simply a more financial objective than what you might find on the other videos and podcasts on DadsDivorce. So we have a special guest with us tonight to walk us through this very complicated situation, and that's John Scott. He's with a CPA firm in St. Louis, Minkler and Diehl, a very prominent CPA firm, I might add. And he focuses on issues that relate to mostly affluent individuals and small to medium-sized businesses. But it's not to say that what he says tonight or what he has to offer us will not be helpful to all of you. But I will say this, to the extent that there are things we talk about tonight that don't hit directly on items that you have an interest in, John is willing to respond within limits to certain email requests that you might send to Cash Counsel or to DadsDivorce.com. But mention Cash Counsel, mention John Scott, and to the extent that his schedule permits, he's willing to follow up and try to answer some of those questions. With that, John Scott, welcome. We're glad to have you here.
Thank you, Joe.
And I know that we have a short period of time to crunch through a lot of information, so I'm going to kind of let you suggest to me things that might be of importance to our audience. And I guess we could begin by looking back in 2008 and talking about some of the things that happened there.
Yeah, I think that'd be a good place to start. The theme seems to be change. The election season all revolved around change, and that's what we have now. And what a year it's been. I mean, we had 3 new tax acts this year, so we can talk about those. We can also talk about next year and what the future holds, and then finally we can talk about some year-end planning ideas to see what people can do to mitigate their tax situation currently.
And there's a lot of uncertainty, though, isn't there, about next year?
There is a ton of uncertainty. When the president-elect ran, he ran on a platform that said if you make above $250,000, you would pay additional taxes.
Because you're rich.
Because you are rich, yes. And if you made below that, you'd get some sort of a small refund. $800, $1,000 is what his website pretty much predicted for many folks below the $250 level. We don't believe that in this economic climate, and this is my opinion predominantly, that taxes can be raised in 2009. So I do think taxes will go up eventually, but I don't think it's going to be in 2009. I think we'll keep the status quo, and then it'll be easy politically in 2010 for the 2001 Tax Act just to expire, and rates will go up that way.
So you don't think there will be cuts, do you, in 2009?
There may be some cuts for mid and lower income, but I don't think taxes are going up on those rich folks making $250,000 or more.
But they won't likely go down for them either.
Correct.
Okay.
They will not.
Okay. So then looking back at 2008.
In 2008, we had 3 tax acts. The first one was the Economic Stimulus Act of 2008. And really, this is the one that the corner piece of this was the tax rebate. Folks who were eligible due to income limits got a rebate check in the mail, and depending on when you filed and what your Social Security number, you got that rebate check that you were supposed to go out and spend to stimulate the economy. It didn't necessarily work, but...
Well, now, incidentally, my check must have gotten lost in the mail. I didn't get one of those. Did you?
I did not either. There are certain levels where...
We must be rich.
Evidently. Evidently. Another thing that was in that act was the increase in Section 179 depreciation. Now, Section 179 depreciation allows small businesses to write off in the first year the cost of their fixed assets.
Oh, now this is big. I heard about this. Go ahead.
It is big, and the purpose of this is to incent businesses to invest in their business. And when they do that, they go out and they spend money on equipment, which then they can take a deduction for in year one. Well, that helps the person selling the equipment and spurs on their business. So this is probably a bigger incentive to the economy than anything else that they could have done. So the new limit on that is $250,000 of up to $800,000 in fixed asset purchases.
But it was higher than that for '08, wasn't it?
It wasn't necessarily higher, but when you couple it with bonus depreciation, which is the next thing I was going to talk about, bonus depreciation allows you to take the first 50% of equipment purchases and write those off. So you can couple these things. So on a $500,000 piece of equipment, you could get up to $400,000 of depreciation in the first year.
So now, and I hope that people who are listening are thinking about how this may have application to them. These are not just advantages to people who are wealthy. Those of you out there who have a business in which you've simply bought some vehicles, bought some other equipment, you can very easily, in this day and age, get to $400,000.
Well, and really what I tell clients this time of year is if there's something you're considering buying next spring, why not buy it now? Take the deduction this year and offset your income this year. You were going to buy it maybe 4, 5, 6 months from now. Why not buy it now with debt and then pay for it over time, take the deduction now? I wouldn't advise a client to go out and buy something they didn't need. But if you need something and you're going to get it 6 months from now, consider buying it before year end.
And there are limitations on going out and buying a new Mercedes or BMW for the business, right?
Right. Many times in the past few years, folks were buying SUVs that do qualify for 179 depreciation. They have to be in excess of 6,000 pounds gross vehicle weight, but Congress put in a limit on that a couple of years ago, and they said the limit is $25,000 off the top and then normal luxury auto limits after that. It's still advantageous, but not like it used to be.
And that was really a good advantage, and I remember taking advantage of that. It was, I think they defined it as a commercial truck.
Right.
And if you had this, whether it's an Escalade, whether it's a BMW, Mercedes, a vehicle that weighs 6,000 pounds, that was the criteria, you could write off the whole thing.
Right. Up
until, I think I did it last time 2 years ago. But you go out and you spend $100,000 on a vehicle and just write the whole thing off. It was a wonderful thing, and loopholes like that don't often last very long.
The car salesman loved it. It was a huge home run.
Okay, so I think everyone heard how that's closed. If they get a luxury vehicle that qualifies as a commercial truck, it's $25,000 is
plus 20% of the remainder.
Of the remainder. So it's still a significant benefit.
Right. They did also raise the luxury auto limit. So if you didn't buy the $75,000 big car, if you bought a $40,000 vehicle, the limits have been increased by about $8,000. So your first year depreciation on a $40,000 vehicle could be as much as $10,000 or $11,000.
It's good.
We got another act in July called the Housing Assistance Tax Act. And here for first-time homebuyers, and first-time homebuyers is not necessarily someone who's never had a home, but maybe someone who hasn't had a home for a few years, there's a $7,500 credit. Now, there's a little misnomer here in that you get the $7,500 credit, but you end up paying it back through your tax returns over the next 15 years. So it's not as nice as it sounds. I know it's been touted as a big credit, but you do end up paying that back over time.
Well, you said something that I want to be sure people caught it, is when people hear the phrase first-time home buyer, naturally they'll assume that it means what it says, but they don't know the tax code. So
Right.
It really means, as you point out, that they may not have owned something for as recently as 24 months ago. Is that correct?
You know, I'd have to check on that. I think it's 2 or 3 years is the cutoff, but it does encompass more than your adult children who are buying their first home. If you've been in an apartment for a few years, you could be a first-time home buyer.
So a guy who's gotten divorced and maybe it's been 2 to 3 years in an apartment, now we hope that wasn't the case. Couldn't have been a Cordell and Cordell client that happened to. But anyway, they end up in this apartment for 3 years. There's a chance that if they go out and get a house, that they'll get this.
They could qualify for the credit.
Okay.
Now, there are some income limits that apply there. If you're single, your AGI has to be